So why is it that you think that capital flows will continue flowing into these tech stocks this year?
Sure. So I don't think that 100% that's no guarantee, but
Right.
I think it's as long as you have a U.S. population that's largely employed, they're putting money into their 401ks, and that money automatically goes to ETFs that track indexes that are market cap weighted. So if you're a big company in a market cap weighted index, you there's no analytical discernment between what happened with rates, what's your fundamentals, what's your valuation. It's just allocate according to float adjusted market cap.
Emma Muhleman joins us today. She is the global macro strategist and portfolio manager at Ascend Investment. You'll also see her regularly on TV on channels such as Fox Business. We'll be talking about her macro outlook for 2024, as well as her interpretation of what the market is doing right now and how it's reacting to the latest economic data. First, a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space, as well as unique tax benefits. So if you're over 18 and you'd like to open a new account with cash or roll over an existing account, click on itrust.capital/David in the link down below to get started and learn more. Emma, welcome to the show. Good to host you today.
Thanks, David.
As a global macro strategist, you focus on not just U.S. markets, but globally. So we'll touch on U.S. markets first, and then talk about some other areas of focus of your research outside of the U.S. First, let's talk about recent market activity. Just as we're speaking today on Monday, the 5th of February, stocks fell. The Dow is down about 300 points. Treasury yields spiked today on fears that the Fed may not cut rates as soon as some may have anticipated. Emma, what is your view on monetary policy given economic data that was released recently?
So my view hasn't changed much just based on the
Okay.
one, although it was, a blowout release. But if you look previously, the revisions were always negative. And
Hmm.
people, so they'd be like, oh, the jobs number came here, but that was against a revised previous number that was always revised downward. Either way, it's one data point. I thought going into that jobs report that the markets had overly priced in cuts too early, too fast all along.
Yeah.
Simply listening to Powell, reading the I don't emphasize too much the dot plot, because Powell all the way has frequently said the dot plots are just a bunch of people going like, don't.
Right.
He even goes like the neutral rate of interest, like he kind of like mocks it. So
Right.
try not to put too much emphasis on that. Whereas you'll see a lot of people go, oh, the SCP says, well, still, okay, fine. If we go with the SCP, it's still set a lot lower than what the market had priced. And so what I've learned over the years is the market likes to price what they want to, what they
Hmm.
want to happen, rather than what is suggested, what looks like is going to happen, or what they're being told is going to happen.
Yeah.
Uh, there have been cases in the past where I've made a lot of money doing exactly what they are doing by buying euro dollar futures, believing the Fed cannot do what it says it's going to do.
Sure.
In this case, uh, right now, I can't, I would have no justification for fighting a Fed that says we're going to do 3 cuts or no cuts or maybe 1 cut, and betting on 7, 6, or what has now adjusted to be fewer.
So if the market prior to last week's jobs release was betting on maybe 6 cuts, let's say 6 cuts, the equity markets, that is, would you say that the equity markets may be in for a downward surprise this year if those expectations are not met?
So certainly some equity markets would. I would say, your Russell 1000 would.
Okay.
Your Mag 7 is kind of like your safety trade at this point. So money's got to go somewhere. There are a lot of funds with mandates that have to be in, say, U.S. equities. Um, and there's a lot of flows that come just from vanguards. And if you have a population that's employed, they have 401ks, they're putting money in it, it's going to a vanguard fund that says, if I give you money, put it in equity markets. So that just flows into the big Mag 7 and the big caps. So if the market were, we have a down day like today, 300 points down. Let's see what happened with the Mag 7.
I want to come back to your point about why the Magnificent Seven stocks are a safety play at this point. Some people have said that their valuations have been overstretched. First of all, do you agree with that? And second, would that be a concern for you?
I agree with it, but it's not a concern for me so much.
Okay. Um,
Because what I see is I see a market that's what drives prices in the markets these days is less valuation. Like, oh, is it consistent with the DCF or historical valuations, and more based on just supply and demand and capital flows.
right. So why is it that you think that capital flows will continue flowing into these tech stocks this year?
Sure. So I don't think that 100% that's no guarantee, but I think
Right.
it's as long as you have a U.S. population that's largely employed, they're putting money into their 401ks, and that money automatically goes to ETFs that track indexes that are market cap weighted. So if you're a big company in a market cap weighted index, you there's no analytical discernment between what happened with rates, what's your fundamentals, what's your valuation. It's just allocate according to float adjusted market cap, and
Mhm.
so it goes into your Microsoft. The portion that's allocated to the Nasdaq, mimicking ETF, goes into your Mag Sevens, and some of that goes in. Some of the Mag Sevens are in the SP 500, so they just have this continuous bid. And so until you have a uh, net outflows from the total equity market, so you don't have like money from retirees and 401ks and target date funds going just flowing into passively managed ETFs, until you have a net outflow. So say you've got a bunch of retirees, which we do, and say our millennials lose a lot of jobs, and so or they just decide not to use their 401ks. Just a hypothetical scenario where the net money going to passive is outflowing instead of inflows. And that's the only case in which you'd see those big stocks really take a hit, because in that case it could
So
be
do you believe large caps will outperform the small caps this year, like they did last year?
I do, yeah.
Okay. Um, do you think inflation's coming back at any time this year, next year?
I would expect it this year, given what's going on in the Red Sea.
Okay.
uh, we have, I think it's 25 or 24% of all container ships that carry your types of like clothing, small mechanical goods, things that the US likes to import cheaply from other countries. Those 24% of those container ships you would usually take the route that they can no longer take, and now have it 2 weeks each way. Like, how does that not cause inflation is what I'd have to ask. Um,
Mhm.
Nobody's going to insure those routes the other way. And so I'm still like a bit puzzled as to why no one's talking about that. But
Yeah.
seems like nobody's talking about the inflation that's likely to result from this. Like, we haven't heard that Chair Powell didn't say a thing about it. And nobody asked about it.
Well, do you think that the reduction in the money supply that's happened throughout last year will offset any supply shocks that may come from the Red Sea or other places?
No, see, that's the thing. I've always thought it was interesting how when the Russia-Ukraine situation broke out,
Hmm.
and Powell said, "Oh, I'm going to reduce inflation. Um, I'm gonna." It's like he can't reduce the price of grains that are not coming out of the Ukraine because
Sure.
Russia's invading it. So all he could do is limit what we import, or limit what how much gadgets or clothes I buy. Things like this. Um, like oil prices are beyond the well, yeah, oil prices are beyond the Fed's remit. I mean, right? So like these things are still going to contribute to inflation regardless of, unless the economy's in total collapse, right? Like, if he can try to reduce the money supply, but as long as people are still gassing up their cars, and as long as people are still flying on planes and using jet fuel, things that come out of the refining process,
Yeah.
we and oil prices are high because of the trouble that was going on in Russia and Ukraine. This is back when he first started saying, "I'm going to reduce inflation by tightening money." Um, it's kind of out of his ability to address external supply shocks. Whereas, yeah, he can reduce the amount of like Louis Vuitton purses people buy and things like that. Kind of wasteful spending type of things. But I think what he was trying to do is fix what he had done before, where he injected some 4 trillion, 3 trillion into the market, and um, continued to say inflation was transitory for too long. So tried to make up for his mistake, but in a situation where it's kind of not exactly a one for one fit.
It's interesting how you brought up the Red Sea. So tensions in the Middle East are escalating, as you know. There's a back and forth between the U.S. and Iran, with the U.S. airmen or servicemen killed last week in Jordan. But the markets seem to be shrugging this escalation off. At least on the surface, the S&P is not responding. Is there a reason for this? Do people just not care, or what do you think this is going to escalate beyond control?
Well, I don't know whether it's going to escalate beyond control or not, because it would take knowing a lot of things to be able
Sure,
to give an answer to
sure.
that question. But I think what we've already seen alone will impact goods prices when you've got something that used to take whatever 2 3 days to transport across the ocean now takes 2 weeks, and then another 2 weeks back, and a lot more fuel, and insurance rates are higher.
Hmm.
And, I mean, it's all of those coming together should lead to higher prices for imported goods
Right.
in the United States. And if you're looking elsewhere, it's going to be similar.
But generally speaking, do you think geopolitical risks are something to, I guess, discount into prices right now? Because that's not what's happening.
Yeah, absolutely. I mean, and I think, or you could look at it as, if you can understand the geopolitical risks and where they're likely to flare up the most, and what those areas produce, or what critical commodities they may supply to the global economy, you could look at it as a way to, as an investment opportunity. It's unfortunate the way you. So,
Hmm.
for instance, when Russia invaded Ukraine, I was on Fox Business talking and saying, "Hey, buy CF Industries, buy
Yeah.
uh, nitrogen fertilizer producers, and buy grains." But similar things could be done in a scenario like this. But in general, like geopolitical risk being heightened should be priced into the market, but I don't know how you would measure that it is or it isn't.
Okay. So it's not a concern for you at this particular moment. Like you're not selling assets because there's a war going on. It's basically what you're telling me.
No, I would be looking to. So the way that I manage money is we don't have a mandate to have be invested all the time. So
Hmm.
I think cash holding US dollars, that is an active investment position in and of itself.
Hmm.
So we've got plenty of cash. Maybe I have a higher cash balance, or maybe I'm looking for opportunities as they might emerge as these conflicts
Well,
material.
I mean, just on the cash balance, the interest rates are expected to come down somewhat this year, which means your return on cash would be a little bit lower than last year. Would that motivate you to rotate out into something, or is that not a concern for you?
Well, so we're not holding all cash, right? Of
Yeah,
course,
yeah, for sure.
that's just something that we have opportunistically the ability to, buy. Typically, optionality. The way that I like to express positions is through long options, and there may be a spread there, so that I'm saving on the cost of carrying the position, because long options, it costs
Hmm.
money. But the asymmetry to that profile, when everybody's here believing this, the herd's here, and you're like, herd, there's a 50% chance, say the herd is wrong, but they're
Hmm.
all here. They'll sell me options for almost nothing, saying things go the other way. Think Brexit. Um,
Yeah.
and so you can express this with options in so many different ways. Like, if going into Brexit, if you were simply long options on the yen, you made a ton of money. Long calls on the yen, excuse me. But so, because we deploy it in such an asymmetrical payoff format, we can sit with a good amount of cash and then just jump when we see the opportunity. Um, so no, I'm not concerned.
Right.
And I also don't think rate cuts are going to be as aggressive as the market's pricing. I still don't
Sure.
believe
So if you believe, just to clarify, you think inflation is going to come back somewhat because of supply chain issues, not because you think the economy is going to come back roaring in the
it. Yeah,
US?
no, I don't think the economy is going to come back roaring. No,
Okay.
but I do think that, I mean, we've already seen enough to expect some degree of inflationary pressure from supply concerns, I would think, unless
Sure.
I'm just missing something.
Sure. So generally speaking, then, what is your main thesis for 2024, and how that affects your overall asset allocation? I mean, in 2022, I guess it was inflation. 2023, we had a big, banking crisis at the beginning of the year, and then markets came back from that. In 2024, what do you think are the major themes?
So I'm still watching the BOJ.
Okay.
I think I think people are coming to finally reckoning with the fact that the Chinese reopening trade is not ever going to materialize as they wanted to believe for so long. Um, the reopening trade is whatever you think you've seen so far is gone and done. Okay, so the stimulus from China is not going to be blow out and save everybody that wants it to. This because remember China this morning said, oh, I mean it was in China yesterday, um, we're going to do a stimulus and but didn't give it details. And then the CSRC came out. So in China's markets for Monday, they were down the first half of trading, and after lunch break, CSRC came out and said, we're going to put these restrictions on short sellers, blah, blah, blah. You know what I'm talking about, the quant restrictions too. You can't sell those. You can't, and those are margins. So that's a tough one. Um, that's not enough. That's not enough to send China rebounding. And I'm hearing people talking about now getting into like FXI and saying, oh, look, I mean, these things are cheap.
Hmm.
Be careful when you say cheap about China. So I think, this may be the year that people realize it's time to look elsewhere.
Is there going to be a real estate collapse in China, which will lead to a complete slowdown of the economy, which will affect other markets outside China, like the US? Is that happening?
I mean, yeah, I think that's already happened. I mean, I think it's already happened, except for the prices because of the way China has insulated itself in with capital controls. And I mean, I know
Mm,
it's very hard to keep capital inside of a place when you've got one point, we'll
sure.
call it dollar revisions, 1.2 billion people. uh,
Mhm.
but hey, I have to commend them for their competence in that regard. Um, the pricing inside China is beyond bizarre. I mean, I have agents that are like trying to sell me an empty, unfinished apartment on like the crappy areas outside Beijing and that don't have like toilets in there yet for like the equivalent of
Yeah.
US $17 million. Like,
Right. Right.
like, what? What? So I think, yeah, I think it already has collapsed, but the CCP has been able to prevent, you know, so they took two more troubled debt companies and made them state owned just recently. That was last week, I believe.
Yeah.
Uh, like similar to Huarong. Um, so that's one way of papering over a troubled debt asset manager that's not getting paid on their troubled debts. Troubled debts,
Right.
bad debts that are actually going bad. Um, so if I had to guess, that's probably why they did that.
Hmm.
Um, so they're trying to keep things from the appearance, at least especially to the international world,
Yeah.
looking like they're not collapsing. But um, some of us who look closer, we can see. And so, for instance, also I think this was this weekend, the U.S. Embassy posted on Weibo. I don't know if I'm saying that right. I'm probably not. A thing saying, "Oh, look at how great the giraffe population is being taken care of," uh, and then the Chinese citizens took to the comment section of that post in Weibo to just vent because censorship is everywhere else, so
Sure.
they just went nuts on the comment section. They're all about how the markets are a disaster, how the party has like diminished all hope. And I mean, it's some really strong words on there, and it's very interesting that you know it shows you something about the level of censorship that they went to they're trying to get it heard by external people external to China, right?
Right.
But that's why they use the U.S. embassy's thing into
But
comment.
did you say giraffe population? I misheard you.
Yeah, the giraffes.
What what is the why I don't understand the reference
I
there.
didn't actually see the embassy post. I don't know if they're talking about the giraffes at the San Diego Zoo or what. Um,
What are they
but
talking about?
yeah, they're talking about some environmental measures. Look how great we're doing at
Oh,
protecting the
okay. Okay.
and then the Chinese people were like, yeah, you know what? The giraffes, my bank account, you know.
You know, maybe that's a proxy where that's an indicator for the economy, you know, how the giraffes are doing. I digress. You mentioned Bank of Japan. So the Bank of Japan is currently still at negative interest rates, I believe. They're talking about potentially raising rates. If they do, Emma, would that be a long yen, short dollar opportunity since the Fed is doing the reverse?
If they did, that would be a long yen. Yeah, I agree. And it would also be you'd expect 10-year treasuries to yields to rise, rates, not
Hmm.
rates, yields to rise, and yields in Europe as well. I mean, so the BOJ is basically by way of its yield curve control and negative rates, and all the money that sits at life insurance companies in Japan, they got to deploy it somewhere. I'm not going to deploy it here negatively. And also, when the BOJ's bought half the JGBs, I mean, there's that. So then they go abroad and they go buy crappy government bonds and the
Sure.
likes, Europe, and one might argue crappy government bonds in the U.S.
Hmm.
10 years.
Hmm.
And so they've effectively created a put on yields on sovereign debt, global developed sovereign debt markets. And so we could all have a little bit of a reckoning and maybe pay a little more attention to the BOJ if they actually do, you know, move out of negative rates and into more,
So,
if they do material that way.
so generally speaking, what is your view on the 10-year, US 10-year this year?
My view on the U.S. 10-year this year, I think that it'll steepen. The yield curve will steepen. So you'll see the 10-year go up,
Okay.
30-year will go up, 2-year will go up
Hmm.
less so.
Okay.
But yeah.
Okay. And well, given that outlook, what is your view on the 60/40 asset allocation model, 60/40 being 60 equities, 40% fixed income?
So 60/40, it's actually interesting. So the risk parity funds, or these are ones that are supposed to be just better than the 60/40 because they quote unquote dynamically adjust their allocations to keep volatility in the total portfolio to a minimum. That it's often called your all-weather fund, or
Hmm.
uh, they have had volatility that's way higher than if you just did a static 60/40 model. And the last like 2 years. Um, so did those so my view on 60/40 is, well, I've always had so I have an opinion on the risk parities and
Okay.
the 60/40. I used to pick on risk parity, but before that I picked on 60/40. Now I'm like, I mean, I'm not a big fan of either of them because correlations change
Hmm.
um, with different regimes, and that's the nature of financial markets. So to try and say, oh, we're going to do this is I have a background in machine learning and AI too, by the way. So
Oh,
a,
okay.
one of the themes that people try to do when they try to apply this to finance is they use correlations, right?
Right.
Just like this is total. To be frank, when I was in the program, and I come from finance background, I'm like, to be honest, like this is total crap because correlations aren't static; they're non-stationary, and they don't. Maybe in some regime they persisted, like the bond bull bear market of the last 30, 40 years. 60/40 may be great, but in a new regime where you've got inflation to worry about and actual interest rates, the actual 4%. Oh my gosh. Ooh, God forbid somebody gets paid for the cash. Things will change, right? And
So,
so
Right. So what is there an ideal allocation, um, I guess methodology or percentage right now that you would subscribe to?
Um, so I would say I would subscribe to a methodology that says have some cash unless you see something that's really have some cash paying 4% or whatever you can get in the money market fund, um, ready to be utilized when you see something where you have high conviction that you can actually make money. And I don't like to say, oh, I want to be all in bonds or I want to be all in equities. It's a constant something that you have to tactically adjust, right?
Hmm.
Um, as developments occur. I mean, right now I'm not a big fan of equities, but I'm not like super negative on it either. I don't want to pretend I know more than I do.
Yeah. So you're not a big fan. You're not super bearish either. Are you?
So
Are you
we have an allocation to equities, but I
right?
can't do anything much more from the fund perspective.
Sure.
Well, but so I'm not like saying, oh, we're cutting off, we're going net short.
Yeah. Tell us a little bit about your fund strategy, how it works. Yeah.
So it gets a bit complicated. And I know we only have so much time, and so I
Sure.
don't because there are silos for certain high
Sure.
multifamilies that have different rules. Um, but generally speaking, it's opportunistic and event driven, and the actual mandate allows us to do pretty much anything we want by calling it absolute returns. So if we don't see anything that's like where we say, hey, the market looks really wrong on this, then we might have more cash. It's,
Hmm.
you know, so prior to, let's say, prior to the recent adjustments to downward in terms of the number of or size, number and size of rate cuts and how soon, um, I was betting that the market was this. You look at the swaps market is to see what's really embedded in market pricing for rate cuts. The swaps market was pricing in something like at before the latest adjustments, they were pricing in something like 108 basis points cut.
Hmm.
And I thought, I don't think so. So selling, so basically in the fixed income market, that would mean convexity is underpriced. Um, I'm sorry, convexity is overpriced. So it makes sense to like go and buy. I mean, it's not a bad idea to buy something like RMBS,
Mm.
uh, because they've got Fannie Mae RMBS, for instance, 30-year. Those are supposed to be just like government bonds, federal backed government bonds.
Yeah.
So the default risk is like not there. People aren't prepaying, right? And not with rates like this. So prepayment risk is where the convexity comes in. If the convexity is not the convexity when you buy an RMBS would typically be not in your favor. You don't hold that option. The
Sure.
homeowner holds the option, right? They're
Sure.
not going to exercise it when rates are like this. So
Absolutely.
any extra that you get paid for buying an RMBS because of that convexity, the negative convexity embedded therein, is kind of like free free dough. To use the
All right.
technical terms.
Okay.
um, I like that. I mean, uh, I worry that the U.S. dollar is going to be strong again, and start ripping through. When the U.S. dollar is strong, everything else tends to be. A strong U.S. dollar can kill everybody's dreams and hopes, and so
Hmm.
we could see that. Um, it all depends on it. Powell has been surprisingly consistent with two times where he's just bizarrely the other way. And so there was the pivot in 2018, the end of the year, December, when he was like hawkish, 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 and then all of a sudden he's sitting next to Yellen and Bernanke at the Economics Club in New York, and he's like, "I thought I was looking at a vampire," like, and I was like disillusioned is all I could do. Like, where did this guy come from, and what everything he said in the past is not consistent with what he's saying now when
Hmm.
that infamous pivot. And then you had the recent December, all of a sudden, him talking about rate cuts. And now he's back on track to his standard. We need more data. We're not going to be hasty and, back on that chain. So he's, should he continue to be the Powell that I know most of the time, then I would expect dollar strength
Okay.
because the market's obviously expecting him to not continue to be
Mhm.
hawkish. They're expecting him.
I want to end on actually, you mentioned you have a background in comp sci. So, what are maybe some of the most exciting AI or computer developments happening today that you're watching?
I mean, in terms of financial markets, or
I think just in terms of just impact on technological innovation, it doesn't have to necessarily have a financial impact, but just something that excites you.
a couple things. Computer vision for sure, and we're getting a lot better in terms of. So one of the main like setbacks, at least as far as I got in this field,
Hmm.
was the problem with robots not being able to like pick things up. Like we could
Okay.
have machines do so much stuff, but picking up a loaf of bread, like the dexterity issue they're getting, as from what I read. I'm not doing it anymore, but I stopped there. I went, I don't need to learn how to make the robots dexterous. You know what I mean?
Okay.
But those who do, I think they're making a lot of progress there, which could change. I mean, which could increase productivity a ton. And I also work. There's goods and bads here, but I think we are going to see a future where you've got 3D printers that can print a lot of the things that may have left China to for Bangladesh to
Right.
produce widgets that ultimately come to the U.S. But later we'll have some robots in the Midwest that ship to each coast, and that could prevent certain still emerging economies from ever really industrializing.
How would you as a portfolio manager use AI? Suppose somebody came to you and say, "Hey, we're selling software. You know, tell us how you could use our services. What would your ideal, I guess, utilization be?"
So somebody who's selling AI or machine learning related software,
Yeah, yeah.
I get this all the time, like every day.
Really? Okay.
Oh, you have no idea how many of them there are out there. So ideally, there would be one that would come to me and say, "Hey, we at a reasonable price. I mean, and reasonable is still pretty high in this
Yeah.
industry. We're able to. Everybody hates the data engineering chunk. So there's camera feeds outside of Walmart's that are capable of. You can run software and count the cars in and out. You
Hmm.
count all. There's all kinds of things. If they could engineer that data, do it right without mistakes, by the way. Um, and instead of selling me just like, okay, we can just do just the Walmarts, or we do just um, the satellites over China. There's satellite imagery over China that looks at the shadows from buildings to like triangulate if there's actual activity going on in infrastructure building.
Okay.
So a company that was like, we are the data engineering and acquisition beast, and we convert that, and that's software required, a lot of software required. That's all the time that most of this stuff takes, and that's where the real value is. If you ask me, when it comes to the investment landscape,
Yeah.
you're not going to really. AI is not going to be running investment strategies that are better than humans. To be frank,
Let me rephrase the question a different way. In what way could AI give you, as a portfolio manager, a competitive edge when it comes to having access to information?
that's where I'm going with this.
Yeah.
So that's how. So for
Right.
instance, that's actually why I got interested in it in the first place, is because I'm looking at. I was work a long ago. I was a analyst on Allianz's ag fund. They've got a 5-star ag fund,
Hmm.
uh, and so I was obsessed. Everything in my life was ag, but so it was defined from fertilizers to chicken production
Yeah.
to. I was all over the Midwest, and finding out that I knew how the WASD report was going to come in, and that influences futures for lean hogs, for corn, for and then which in turn influences the prices of Tyson Foods, Pilgrim Fried, ADM, all these companies. And so when you have the information about the crop conditions um, ahead of that WASD report, you can make a lot of money. If you just think of the movie Trading Places, or it's trade, that's the name of it, right? Where they sell with J futures. So if you think about it like that, but it's not pernicious, and it's not against the law. You're allowed to use satellites over the Midwest and gather the data on the quality of the soil, and you can then tell. The only one thing you can't predict is the weather precisely.
Okay.
But you can monitor it, right?
Yeah.
And that can be applied, that same type of thinking and data gathering in advance, so you can trade ahead of the WASD release, or your positions on ahead of the WASD release, and make a lot of money. So I think people are working on doing that, and they will be in the future for sure.
Excellent. All right, Emma.
Because of the name for it.
Yeah, for sure. Very interesting. Oh, well, hopefully someday an AI company will actually come to you and provide you with things they need. Until then, we'll look at giraffes as an indicator.
Check out that article though. It's on Bloomberg.
Yeah, I'll check it out. I've never seen it before, but I will. Thank you. Where can we learn more about you and Ascend?
You can find more at ascendinvestmentmanagement.com, and then more about me, you can find me on LinkedIn with my name. I won't
Okay.
spell it here. And Twitter, same thing, but
Yeah.
Emma CFA1.
We'll put the links down in the description below. Thank you very much for your time, Emma. Speak to you again soon. Thank you. Thank you for watching. Don't forget to like and subscribe.